Hi there, and welcome to the presentation here on selling to private equity. Thanks everybody for joining, and looking forward to talking about selling to private equity, and hopefully can get a lot of value out of today's presentation. My name's Trevor Crow. I'm with the firm Deutsche Crow Legal, and we are a boutique business transactional firm located in Denver, Colorado, and we focus on M&A transactions in the lower middle market. Mostly M&A deals between $3 and $50 million is where most of our deals are. We'll usually have some deals above and below that in any given year, but for the most part, that's the area where we play in. And we work across industries, mostly there's just a few industries we don't work in, I would say, some highly regulated industries, but for the most part, any type of M&A deal, we're going to be in that range, we're going to be a good fit for. And so today we're talking about selling to private equity, and a lot of our clients have built businesses that they're ready to retire from and are ready to sell. And when they're going out to market to sell that business, private equity is oftentimes a buyer. And so this presentation is about, what are the things to think about when you're selling to private equity. And we've narrowed it down to 12 questions that you should be asking to help make sure that private equity firm is the right fit to be the buyer in your situation. So, just background on me, I've been practicing for 16 years doing M&A deals and general corporate work and securities work. So that's kind of bounced around to several firms in Denver before starting my own firm and then merging with my partner Stan to create the firm that we have now. And so that's just a little background on me, and want to just jump right in since we don't have much time into the presentation here. So going to the next slide here. Okay, so when you're thinking about selling to private equity, you got to remember that PE buyers aren't just acquirers. Oftentimes they're your partners post-closing. The way the deals are structured, they're often rollover equity, so you're going to retain some skin in the game. And so understanding the buyer's strategy and expectations are going to be really important. So, it can be pretty easy for a seller to go out and they find a buyer, and it's a private equity buyer, and they think, great, I found a buyer, and we're all set. And without thinking about doing much diligence on that buyer themselves. But I think there's got to be a mindset shift. It's oftentimes not a complete sale where you get a walk away from. So the PE firms aren't just buyers in this case, they're often your new partners, your business partners moving forward. So you want to treat it that way. And they're really partial exits, as I mentioned, with this rollover. So you'll still have skin in the game, and you're not cashing out totally. You're reinvesting and betting on this business moving forward, but you're betting on it with somebody else who's going to be in control of it. And so it's kind of a second leg of a race, and you're betting on how that second leg of the race is going to go. So anyway, bottom line in the mindset shift that you need to have when you're selling to private equity is that this is going to be somebody that you want to treat as your future co-founder or future partner moving forward. And are they the right fit to maximize value, long-term value for the company? Kind of already mentioned this, but to reiterate, this is a long-term relationship. So the private equity firm is going to be controlling. Typically, they're going to buy a majority, and you're probably going to be rolling over a minority interest. And so you're still going to be on the hook, likely operationally. They oftentimes want you to stick around and operate the business for a while post-closing, not just a small transition services period, but actually run the company for a while. So you're going to be interested both operationally, you're going to be interested financially with the rollover equity, which is cash you didn't receive at closing, as well as potentially a seller note that you have to help finance the transaction as well. And then when you're on the hook or interested both operationally and financially, then you're going to remain interested emotionally as well. And so you're not going to be able to have the clean exit where you wipe your hands clean and walk away with your money and right off into the sunset. There's oftentimes, this like I said, operationally and financially interested, and so emotionally you will be as well. And so you want to make sure that you're aligning with somebody who you trust and has the team and has your legacy and ability to bring your brand forward. So those are really the main things you're thinking about here. And so we put together 12 questions that we're going to be walking through today. And it's a little bit about diligence, but it's also about protecting yourself, both the wealth that you have created in that business, the value, and protecting that, making sure that that value continues, and really avoiding any regrets moving forward. Because if you find the wrong PE buyer, it's not just going to affect this business that's been sold. This affects your second bite at the apple and really your peace of mind. And so you want to make sure you have the right partner moving forward. And so I think these questions that we're going to walk through are really designed to help you find that right partner and make sure that this private equity buyer is going to be the right fit for you. Sorry, and I forgot, excuse me, forgot to mention in the beginning, if you do have questions, there is a Q&A function, and I should be able to see it if that happens, and we can walk through those as they come up. So feel free to put any questions in the Q&A box, and I'll do my best to answer those as we go. So let's jump into the questions here. Here we go. Okay, so question one is, what is your investment strategy and typical hold period? So you want to understand what their plan for exit is, and what their investment strategy, what they're bringing to the table, what they're going to be investing in, how they plan to grow the business, and how long they're planning to hold. A lot of times that's going to be a function of the private equity firm's documents. So they're going to have a private equity fund operating agreement likely, and it's going to have a life of it. So they've gone out and taken on investors. Those investors put money in to help buy these businesses, and those people want their money back at a certain point, and they want it back with a certain return. And so oftentimes these private equity funds are set up with a specific life. It could be a 7-year, 10-year, some other life that the fund is set up for. So you want to understand what the life of that fund is. Particularly if it's a fund that's later stage and they're buying they're buying your business after they've been operating for 5 years, then are they planning to flip this whole thing in 3 years? Is it 2 years? What is their horizon for turning it around? And so you want to understand what that is going in. I would say PE firms typically are going to hold for 3 to 7 years, but that range can vary depending on the firm and, like I said, their documents, how they're set up and what they've promised to the investors that they've brought in. You want to understand, are they bolt-on focused, platform builders? Do they know your industry, or are they coming in and you're the first kind of the guinea pig in this industry that they're testing out? So those questions are good to ask. How as part of this, what is their investment strategy and how they plan to operate the business moving forward? So you want to understand that. You want to ask about other companies they've exited. What multiples did they receive for those exits? What's their definition of success? You want strategy alignment, not just deal alignment. So how are they planning to move forward? Your company could be the platform company, and then they're going to bolt on others to increase total revenue and get a higher multiple moving forward. That could be their strategy. It could be that they've already bought the platform company and they're going to be mixing your company in as a bolt-on. So just understanding those items are going to be very helpful for you moving forward to know how they're going to operate, or get a sense for how they're going to operate, and if that aligns with how you think they should be operating moving forward after the acquisition of your business. All right. 2, what investment returns are they targeting? So do they have high returns? So aggressive growth tactic that they're going to be implementing. So there's going to be a lot of change in your business. Is it lower returns? And so sustainable scaling, they're just trying to add a little bit each time. I mean, almost all private equity buyers are looking to grow your business, not just keep it flat. So there's there's certainly usually some aspect of growth that they're looking at, but how much growth do they need? Again, and that's going to affect how they're going to operate post-closing and what they're going to be looking at. So you want to make sure that you're aligned with how aggressive that post-closing phase will be. And this sounds kind of like a finance question, but it's not. It's kind of a behavior prediction tool to understand how they're going to behave post-closing. So if they're targeting 30% plus IRR, understand what that means. That's going to be an aggressive growth, probably lean staffing, possibly high debt, and making fast decisions. And so you want to make sure that you'll be comfortable working in that environment, or that you think that's a good way to go moving forward. If they're content with a low to mid-teen returns, you may be in for more of a steadier ride. And so I would ask to see actual performance from prior portfolio companies from the PE fund. And if they hedge, if they're doing hedges, then that's probably a red flag. And you want to just make sure that you're digging in to see how those portfolios are actually performing and have historically performed after they've bought businesses. All right, so that's question 2. Moving on. Question number 3. How much of the purchase will be financed with debt versus equity? So as I mentioned, these private equity funds are going to go out and raise money from LPs, so they're going to have some equity in the deal. And then oftentimes they're also using debt to leverage the deal. So they're going to go out and they have some equity that they're going to put down. They're going to take on some debt, and that's going to be the purchase price that they're going to be paying at closing. Plus, there's going to be likely some rollover equity on the side of the seller. So the seller, you're going to be rolling over some of your equity and deferring the purchase price that you're receiving at closing to invest in the new company as it operates moving forward. Got to understand what that debt to equity ratio is. The more debt, it can boost your equity value later, but it also increases operational risk. And so it's important to see how the company is going to be capitalized post-transaction. I think this is a very big one, and it's often misunderstood. So, the more leverage can mean higher upside if you're rolling equity, but also means more risk. So that if the debt service eats up the cash flow and they can't reinvest in the business or grow it, or certain loan covenants get tripped, like the debt service coverage ratio or something like that, then there's big problems, right? The bank can come in and starts taking aggressive efforts, and that can really take away from your second bite at the apple on a later sale if they get into trouble with the debt. So, you want to ask who holds the debt, what the capital stack looks like, and whether if you have a note or an earnout, is it subordinate? Oftentimes the note is subordinate, and so you want to make sure that you understand how that's set up. If we can ask the question and make sure that you're not getting paid last, then that's great. Sometimes that's viable, sometimes it's not, but at least asking the question and understanding it going in prior to working on the transaction documents, it's an important piece to understand. All right, moving on. Question 4. So what level of management involvement will you expect from me? So if you're the seller, how much management do you need from me moving forward? Am I going to be a full-time operator, a board advisor, or I'm going to be phased out over a short period of time? So you really want to clarify what your day-to-day role is going to be, and you want to clarify that early. Some founders that we represent, they want to leave early. They're fed up, or they may have health issues, or whatever's going on. They want to leave, and they're not trying to stick around for multiple years after the closing. Others want to stay. Others are saying they, are interested in making sure that the company grows, and that second bite of the apple is very important to them, and so they want to stick around. And maybe they do like running the business. They just didn't have the capital to grow, or didn't have the diversification that a private equity firm may offer by bolting together several of these companies. So, depending on where you sit in that spectrum of how much you want to participate post-closing, this is why you ask this question. So you make sure that you're on same page with what the private equity firm is thinking. So, ask them, are you going to be the full-time CEO? Am I going to transition after 6 months? You want to get clarity early on these type of things. And also want to, this helps us to understand and make sure that we can avoid any employment hooks that are going to be issues, employment hooks tied to the rollover equity or earnouts, things like that. Especially if you're not intending to stick around. We certainly don't want those future payments being tied to you sticking around and being employed. And so that's important things to know. All right, so that's question 4. Let's go to question 5. What are your plans for future growth of the company? So this is your chance to test if their vision matches yours. You want to push for details, not just buzzwords that they're going to throw out. And you don't want to just settle for, hey, we believe in growth. You want to see the actual plan that they're planning, that they're going to use to grow the company, where they're going to invest, what other companies they're going to acquire, what's the synergies that they think they're creating by doing this. It could be a sales team expansion. It could be a geographic reach expansion. It could be, hey, we're going to get some other strategic acquisitions to combine together that's going to offer us economies of scale, things like that. Just understanding what their plan is for future growth of the company and how they're going to actually get there. This is where I think founders or sellers of companies sometimes don't push for the specifics. You want to ask, who's going to execute this plan? How's it going to be funded? And if they can't answer these questions clearly, then they probably haven't thought it through, or they're potentially hiding the ball. In both cases, it's not a good scenario. So that's why these questions are important, to make sure that you're aligned with what they're doing and that they have an actual plan for this growth. They're not just saying, we want to grow, we just don't know how to yet. So this is an important question, and I would recommend that all sellers who are selling the private equity consider asking this question and getting the details. All right, question 6. What are your plans for existing management employees? This depends on the seller, but oftentimes we have sellers who are very concerned about their current employees and whether they're going to be treated right, if they're going to be, all going to be fired pretty soon after closing, or what they're going to be paid, things like that. And so if you're concerned about your team, this is certainly a question to ask them and really understand what their retention plans are, what incentives they're going to be offering, whether the culture that you've created in building this business will survive, or if it's going to be a different culture. Understanding how their culture is very important, because that could lead to a lot of exits of employees down the road. If the culture is a stark difference, that's often hard for employees to handle post-closing, and so there may be a mass exodus. And if you have a lot of your payments tied up in the second bite of the apple here, or in rollover equity or earnouts, then that's important to you to make sure that those people stick around and help build the business, as opposed to leaving, because then the company gets put in a bad situation. So you want to protect your team and see and ask those questions and ask directly, who stays, who goes. Will the team have a shot at equity moving forward? Do you plan to bring in outsiders, consultants, or reorganize the structure? All those are good questions, follow-on questions to ask, around this larger question of, what are your plans for existing management employees? As you know, culture takes many years to build and a lot less time to wreck. So if they're going to gut the team, you need to know before closing how they're going to do that, and not after the deal closes, because you want to be able to weigh that in to your analysis of whether this is the best buyer for your firm or for your company. All right. Question 7. What is the process and timeline for completing the transaction? So a lot of sellers get overwhelmed during due diligence because it's a very tough process, and they're answering a lot of questions, and probably answering a lot of questions multiple times, providing documents to the other side, and then providing documents to lawyers and things like that. So it's definitely a rough ride to get through the due diligence portion of a deal, but you want to make sure that these guys that coming in as buyers have a good process for buying. that they can map out the steps and the responsibilities early to avoid any surprises and to avoid having multiple diligence calls that going over the same thing just because somebody didn't make it the first time, or it's affecting a couple different work streams. You want to make sure that they have a good plan for how that goes. So, ask about their diligence process. Who's involved? What's the timeline? Clarify up front what they need and when, and try to map out those steps, I think is important. And this also affects the momentum of the deal, which is important. So momentum matters in a deal. You want good deals have died, because people get caught in the weeds, and then there's deal fatigue, and was a bad process moving forward. And so that's where I think, this question really gets to the heart of that issue of, do you have a process for actually doing due diligence and closing on this deal that we can do efficiently and avoid deal fatigue, so we're not, pushing closing out for 120 days, 180 days, things like that. It's a deal that can get done in a more reasonable, 60 to 90 days. Usually more closer to 90, I guess, is probably more reasonable, but it's, not something that's going to extend much past that. All right, question 8. How will you value the company and my rollover equity? So, this is obviously a question that when you're at the very initial stages before an LOI even, you want to ask them how are they going to value the company? What multiple are they planning to use? That sort of thing, because you don't want to waste your time on a potential buyer who's not going to be providing a rollover, or sorry, a valuation multiple that is in the range of what you would accept. So you also want to know what your rollover equity is going to be, how that's going to be priced, because oftentimes that rollover equity is going into a parent company that may own other businesses as well. And so how do you get credit for that rollover equity, and where does that sit in the cap table of that parent company? For example, are all the investors that came in sitting above you with preferred stock or preferred units, and you're getting common units below that? You want to know. And my argument to this oftentimes is that we are deferring a cash payment that was supposed to come at closing, and so this should be treated like any other investment of capital. We're investing money in this new company, and so although we're trying to get tax-free treatment of the rollover, that it should still get treated as if it was money invested in the company. Understanding that how they're going to value the company and their structure is important. Asking how the rollover equity is going to be valued, and is it going to be treated with, pari passu with, or the same as all the other investors or LPs that they've brought into their fund, and is there any discounts that they're planning to apply, things like that. And then also what rights will your equity have? And I think we have another question on that, so maybe I'll skip that piece of it now, but you want to make sure that you understand that piece of it too. What sort of rights are you going to have in this new company? Okay, so that's question 8. Question 9. Will there be an earnout? Oh, so this is a big question. You want to know this in the beginning. Are they planning to offer a price that includes an earnout? And sometimes they do. In fact, a lot of times they do, depending on how the company is structured, especially if there's customer concentration issues, or you have a valuation gap that you can't get to on what the seller thinks the value of the company is and what the buyer thinks the value of the company is. So, you want to make sure that you understand whether there is going to be an earnout. Earnouts are tricky. They are very easy to mess up, I would say, and that or potentially be set up in a way that's not a win-win for both parties, where there is not a lot of incentive to hit those earnout metrics. So you want to make sure that the earnout is drafted in a way that is a win-win for all, for them to achieve it, so that the private equity buyer is very interested in achieving that, because it's going to get paid. It's going to create a company that would value well over what they're paying you in the earnout. So You want to ask, what metrics, if there is an earnout, what metrics apply? Who controls them? What happens if goals are missed due to market conditions outside your control? Things like that. Oftentimes earnouts look good on paper, or the concept of them look good, but they can turn out to be a zero in practice. And so, we want to push for clarity in any earnout structure. Again, make sure it's a win-win. Make sure that there's controls in there that don't allow the private equity firm to play any games or do any tricks to not meet it. And then you want to understand what those targets are going to be, so you understand whether they're achievable. Oftentimes we're pushing for, if it's a financial earnout, that it's revenue based as opposed to EBITDA or some other metric, because revenue is going to be the easiest to measure, whereas EBITDA, there's a lot of expenses that go into coming to that number that can be affected by the private equity company who now controls the company afterwards. So these are very important questions to ask. One, will there be an earnout? And then two, it's really digging in on how did they typically structure those? What are they thinking in this case? Who would control it? What how do they set those up, just so that you have an idea going forward before you spend too much time with a buyer who may not have a good structure that you're willing to accept. All right. Question 10. What resources do you bring to the table to support growth? So this is kind of a follow-on question to the question about what is their growth strategy moving forward. But you really want to know, beyond money, what do they add? Do they add any value? Do they have access to networks? Do they have operation help? Do they have access to talent? Do they have a marketing scheme that can be scaled quickly and go run over multiple companies that they're rolling up? Those are important questions. The money part is fungible. Whoever comes in is going to have some money to put into growth and is going to have money to pay for your business. But just having the money, that's kind of table stakes. Every PE firm is going to show up with a checkbook. So what matters is, what else do they bring? Do they have actual operational playbooks, or just decks, PowerPoint decks? Can they open doors to customers or distribution channels, or top tier hires, things like that? These are the things that you want to ask to make sure that they're going to be adding value to the company, not just by writing a check, but also having some sort of strategic advantage. That's the ideal acquirer for you, is somebody who has a strategic advantage that can operationally add value to the company. Part of this is asking what their track record is for helping companies scale. What have they done? Do they professionalize the governance? Do they recruit a CFO? Can they build out a sales team? What sort of KPIs are they looking for? All these questions are things that you would ask, and it separates somebody, a real partner in the business, from a passive investor. And so you want to be able to have them point to concrete portfolio wins where their team has added meaningful value post-close. And so those are the type of things that you want to ask here for question 10. All right, question 11, getting close to the end here. Two more. What information and liquidity rights will I have on my rollover equity? So this is that question that we kind of mentioned before, or I hit on and said there was going to be another question on this. And this is, what does it look like after I roll over my equity into this new entity, likely the parent entity? What does it look like? Do I have any vote? Do I have any control? Is there any major decisions that is not strictly controlled by the private equity firm? Do I get financials on a regular basis, board updates, things like that? So you want to ask these questions in the beginning and see, how do they work with you post-closing? What sort of rights do you get with your rollover equity? In particular, I think the biggest questions to ask is, what are the exit rights? Is there a put right that you have down the road? Is there tag along protection for any sort of drag along rights that they have? And oftentimes when we're representing sellers, we're really spending a lot of time negotiating these exit rights, so that in the future, if they want to cash out, depending on, regardless of what their stated hold period is, those things can get extended. is that we have a way to put that interest back to the company at some sort of valuation metric that we've come up with, some formula where we can say, all right, after this many years, if you haven't sold the company, if we haven't cashed out, I can put this back to you and I can actually realize and cash out of the business that I sold to you, many years ago. So those are important questions to ask. And then lastly, question 12, can you provide references from other companies? I think this is the most important question of all, and it's kind of been peppered into some of those other questions about talking to other people that they've worked with or other companies that they've either scaled or other portfolio companies that they've purchased. But you want to call those founders. You want to ask what it's like work with this private equity firm. How did things perform at post-closing? How did they deal with tough situations, really? And not just their initial pitch, because it's really what happens when the rubber meets the road and there's been a downturn or misses or disagreements, how they've handled those. And so this is probably the most important question of them all, is to get references and actually call those references and talk to them and see how they've performed. So with that, we've hit time. Hopefully this is something that you got some good value out of. I think these are the top 12 questions with several follow-on questions that I've added along the way during the presentation. But these are the ones that you want to ask to make sure that you found a true partner in the business when you're selling the private equity. So I don't see any questions, but I'm not sure that I would see it. Chat, let me see, there's one. Will the slides be available after the call? Yes. Got one question, and the answer is yes, we will be sending these out after the call. So appreciate everybody attending, and please reach out to us if you have any questions. We're happy to talk to you if you're thinking about selling, or if you're thinking about buying, or you just have general questions about either any M&A or corporate or securities type work. We're here to help and happy to talk to you. Have a great day. Thanks.